Porsche SE is not the actual maker of Porsche cars. It is a holding company that owns 53.3% of Volkswagen AG voting rights. And Volkswagen AG is in charge of several famous brands and companies like Volkswagen, Audi, Seat, Škoda, Bentley, Bugatti, Lamborghini, Porsche AG, the actual maker of Porsche cars, Ducati, Scania or MAN. Now, considering the current price of the shares, Porsche SE's ownership in Volkswagen AG is worth around $26 billion. And let's not forget that Porsche SE also owns Porsche Engineering and Porsche Design Group, and recently they bought 25% of Porsche AG, the maker of Porsche cars, and that alone is worth another $14 billion. So the main two assets of this company are worth around $40 billion, and the market cap of the entire Porsche SE is just close to $19 billion. So this company has assets that are worth twice as much as the market cap of the company. So is it a great value play, a bargain that we just can't ignore? Or is there more to the story? Let's find out. So now let's see who owns this company. Individual insiders, that is an X. We don't have any data indicated that the management has even a single share of this company. And we also don't see any transactions from individual insiders. And what about super investors? That is also an X. We don't see even a single super investor putting his money into this company. So, of course, they are not buying. That is not a very encouraging start. It's a big company, so most probably a lot of investors looked into it. But since 2018, we see no buys, and also not a single insider decided to own shares of Porsche SE. That is not a very typical situation at all. Return on invested capital, that is an X at 9.4% 10-year median returns. And we want to see this number higher than 10%. So it is just below of what we are usually looking for. And free cash flow growth, that is a check at 12.2% 10-year compound annual growth rate. And just as with return on invested capital, we would like to see this number higher than 10%, so that is nice. And now let's take a look at share buyback. It is an X. In the last 10 years, they issued 0.1% of new shares. So basically the difference is almost non-existent. And the debt, it is an X. It would take Porsche SE 7 years to pay the debt with a current free cash flow. And they have such a big debt because of the purchase of Porsche common stock. It required significant amount of funds, and they want to reduce it by about 15% till the end of the year. Actually, the management wrote, we will use the dividends received from our assets to reduce our financial liabilities. The dividends received from our core holdings should cover net debt within 4 years. Well, we will see. The dividend yield is 4.5%, and you can expect around 28 cents annually per every share. And the payout ratio, that is an X at 16.7%. And we want to see the payout ratio somewhere between 20 and 50%. So in this case, it is a little low. We could expect a bigger portion of the earnings. But currently, with this massive debt, I think it is actually even too big. And what about dividend growth? It is a check at 6% 5-year growth rate. And what can we expect to happen with the dividends in the future? Well, of course, we don't know, but the management stated that a significant part of the dividends received from our assets shall be used to let our shareholders participate in the success of Porsche SE. So that doesn't really mean absolutely anything. But, you know, it sounds nice. Price to earnings is 4.5. So not only the comparison of the market cap to assets, but also the PE seems to indicate that this company is cheap. But let's value it using a discounted cash flow formula. We will have to estimate the growth of Porsche SE for the next 10 years, and we will make 3 scenarios of this growth. So, in the low scenario, we will estimate a growth of 3% for the first 5 years and then 2%. In the medium, 5% and then 4%. And in the high scenario, 5% and since year 6, 6% growth. And the historical results are not really helpful in this case. In the last 10 years, revenue went down by 27.4%, free cash flow went up by 12.2%, and earnings per share went down by 6.9%. So it is a bit all over the place. And with our estimates, the intrinsic value in the low scenario is $1.76, in the medium $2.32, and in the high scenario $2.58. But we have to always add a margin of safety to those prices. And as always, I use a 30% one. And with such a margin we get, in the low scenario, $1.23, in the medium, $1.62, and in the high one, $1.80. And the current price is around $6. So it is all in the red, and a significant reason for that is the huge debt. And it is a tough one, because one valuation shows that this company is expensive when we look at the free cash flow. But like I said at the beginning of the video, when we look at the assets and compare them to the market cap, it is very cheap. Well, let me know what do you think, but for me there are so many question marks here that it just goes to the too hard pile. Or as they say in Shark Tank, so for those reasons, I'm out.